countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The S&P on track for its 46th record high of the year. But who's really counting? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
You took my thunder. You took my 46 thunder. Alex Steele, nice one. We're kicking you off to the closing bell. All right, you get a record high here again for the S&P. We are around the highs of the session, finishing up strong here, up 0.8%. But guess what? It's not just the S&P, it's also the Dow. But don't tell Romaine that I'm saying that. Also, mid-cap stocks, another record high. We saw that again on Friday. NASDAQ 100 not hitting a record high, but still the highest that we've seen since July. So it's really being led here by tech, but it's still relatively broadening out. S&P utilities remain one of the best sectors right now in the S&P.
And that really could be a good thing here for this market. S&P 500 that's right now looking to do something it hasn't done all year, and that's rally for 6 straight weeks. Fresh off of that 5-week 8% run that pushed it to a 45th record high of the year. The index is starting the new week right where it let off. As Alex said, tech stocks and financials leading the charge as earnings season ramps up. 40-plus S&P companies scheduled to report this week. Now, the outcome of those reports, it's a bit of a toss-up. Analysts coming into this week with lowered earnings expectations, but companies coming into the week holding on to relatively strong guidance. It's an unusual divergence in outlooks that sets the stage for potentially outsized moves in share prices. The reporting period, of course, started on a positive note last week with J.P. Morgan and Wells Fargo, and this week it's going to bring some results from Goldman, from Citi, from United Airlines, P&G, and Netflix, among others. Meanwhile, the economic and fiscal stimulus story out of China is leading to fresh bouts of volatility in Asian markets. Asian markets that saw inflows into U.S. ETFs that invest in China, totaling $5 billion just last week alone. Mainland Chinese stocks on Monday closing higher. And Goldman Sachs strategists, get this, Alex, upgrading their forecast right now for China's economic growth.
Yep, we'll see if that actually winds up panning out. Let's get back to that top story when it comes to earnings. Here's another way of looking at it. So earnings growth for the S&P is looking to come up to about 3.3%. That's according to estimates for the third quarter. We get $4.6 trillion worth of market cap reporting just this week. It's the third biggest week for the S&P numbers. Now, the question is this going to be enough to beat? Now, as Romaine was just talking about, Citi actually said that earnings revisions fell the most since December of 2022. Okay, and you only have 3.3% growth. So that bar to beat is really, really small. And you can see that, say, with Wells Fargo on Friday. You get that beat and you get a monster pop within the stock. So, Romaine, the question really is that how the setup is into earnings season? And then what winds up happening with the Mag 7. So we're looking at definitely decelerated growth, but still you can make an argument that you're looking at profits to rise 18% from a year ago versus 36% in the second quarter. Is that going to be considered good or bad? Like, help me figure that one out. 18% is pretty good, but if it's half of what we saw before, that's a question mark.
Yeah, and I guess the question, too, is, we start to talk about this idea of lower expectations, and we saw that in the last earnings period where, people were coming into that period and looking at the S&P as a whole. We're looking for like 3 to 4% in earnings growth, and what we ended up getting was something closer to 8%, and that's a big part of the reason why you saw an extension of that rally to where we are today at 58.62 and change. Yes, that 46th record high, with the NASDAQ also posting record highs, a Dow also posting record highs, and now mid caps and small caps now trying to reclaim record highs that they have yet to see in quite some time. Gargi Chaudhuri joining us right now. She's the Chief Investment and Portfolio Strategist for the Americas over at BlackRock, joining us here on this Monday afternoon to kick us off to the close. And Gargi, I guess the big question is the kickoff to earnings season. We saw last week with a couple of the big banks providing some relatively encouraging numbers and commentary. Do you expect to hear that same type of optimism out of other CEOs and CFOs as we get deeper into this earnings season?
Good afternoon. It's so great to be here. Thank you so much for having me. I think that's exactly the right question. See, coming into this earnings season, I think one thing that we have to appreciate is how much earnings growth expectations were revised lower. So the first thing that I'm watching for is to see to what extent the beats continue to be both on the top level and on revenues and on earnings. So that's one thing. The second thing that I'm hoping to see through the course of earnings seasons is this optimism around the consumer. So we saw a little bit of that, obviously, as we heard from some of the larger banks. I want to see to what extent that continues. And then the third thing that I think will be important for all of us in the markets is just any kind of commentary around what is going on as companies, CFOs, CEOs are thinking about their labor force. To what extent are they thinking about layoffs, if that's something at all that's coming up? And to what extent do lower interest rates make a difference to their CapEx plans, et cetera? So that's what I'm looking for with the eye on broadening earnings across 8 to 9 different sectors of the S&P as opposed to just a few that we had seen coming into this year.
So you have some optimism that when we get to this end of this earnings season and we have you back on to talk about what happened, we will be able to have a conversation that is much broader than just the Mag 7 and some of those big tech stocks.
Hope so. And I think we're already sort of beginning to see that, or at least we're beginning to see that in what the market is pricing in for earnings growth. We're beginning to see that earnings growth between Mag 7 and the rest of the 493. We're beginning to see that compress a little bit, not just for this season, but for next season as well. We're beginning to see earnings growth in healthcare, in utilities, obviously in the tech and tech plus. And I think we just have to see that continue through the end of this season and, point positively in terms of guidance for next quarter as well.
But, if you take a look at the broader index level, communication services and tech are like 40% of the S&P. So the broader index is going to have a hard time moving higher if Mag 7 don't deliver. Is 18% earnings growth going to be good enough?
You know, I think there's a slight nuance here. It's not about the broader tech and communication services, tech plus, underperforming. It's about everything else moving up. And I think that's what we're expecting. And, you know, we point out in our fall investment directions that we just came out with at the end of last month around how this is a time to not just think about moving away from tech. It's not that at all. We think that tech and quality should be the backbone and the core of your portfolio. But it is thinking about some of these other areas that might have been forgotten for such a long time that are beginning to show some life in August, September, and certainly expected to do so for the rest of the year.
Something I keep pointing out is that mid-cap index doing really well and record high after record high along with the S&P, while the Russell 2000 is kind of lagging. How does SMIDs fit into that allocation?
Yeah, so one of the things that we've talked about, and with you before, Alex, and in other shows as well in our research, is that despite the cutting cycle that has begun and despite economic growth that continues to be pretty robust as of right now, the expectation of small caps to actually vastly outperform large cap is not what we have at the moment. We still think that large cap, and especially right now, we think rotating to large cap value might be a better place for investors. I think we need to see meaningfully lower rates make its way into balance sheet strength for these small cap companies that can then have earnings growth. We need to see that, and we haven't. So I think it's going to be hard for small caps to outperform. And again, this is about the relative performance between the two, not absolute. It's going to be hard to see that outperformance of small cap space.
Do you think, though, and I get that here, if we do get more meaningful cuts, meaning we get that series of cuts that the market has priced in here, and I know there's a lag and all that, blah, 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 but once we get to that, Gargi, do you start to see a more meaningful impact on the bottom line for those companies?
I think we have to begin to see those cuts. And at the same time, economic growth needs to not just be strong, but it needs to be accelerating. So it's not enough to have economic growth as measured by real GDP or other measures, not just enough for it to not be in recessionary levels. We need to actually have an expectation that from here on, economic growth is accelerating at the same time as rates are moving lower. And all of that then manifests itself in many of these small cap companies being able to have stronger profitability, be able to have stronger earnings growth. Yeah. Obviously, we know this number, but about 40% of some of the small cap indices have negative earnings growth. They're not quite profitable yet. So if all of those things take place, yes, absolutely. I'd love to come here and talk to you about IWM and the opportunity it presents. But for right now, not quite yet.
All right. Well, sit tight, Gargi. We're just getting started with Gargi Chaudhuri, Chief Investment and Portfolio Strategist for the Americas at BlackRock. We do need to take a quick break, but she's sticking with us. When we come back, we're going to get her thoughts on what's going on overseas. This is Bloomberg.
Well, Chinese-based stocks are up 32% in the past month after the government unveiled certain stimulus to help the economy. And the move suggests that investors are still hopeful about the government's promise made this weekend to deliver more fiscal support. Right now, it looks like it's more local government debt as well as housing. They're still not cutting the checks to people. Joining us now for more is Gargi Chaudhuri, Chief Investment and Portfolio Strategist for the Americas over at BlackRock. Gargi, do you want to buy China right now?
You know, one of the things that we've seen clients do over the last sort of 3 weeks or so since we got the news is pour money into China ETFs and EM ETFs. And it's been absolutely incredible to see the 10 billion or so that's come in, especially to names like FXI, which gives you access to sort of that large cap China market. I think what investors are really trying to figure out is to what extent this is going to be a sustainable change. To what extent is consumption going to meaningfully change as a result of that? And I think when you look at some of the policies that were expected over the weekend, when you see the monetary policy and the fiscal policy coming into play together, I think that leaves a lot of room for optimism. At BlackRock, the Investment Institute has moved to a tactical overweight for China. The flows are certainly pointing to a lot of optimism. I think what we're all waiting to see is to what extent this actually results in consumption. And that's going to be the next thing we learn, hopefully soon in terms of fiscal policy.
Is that tactical call then still a show me story, though?
I think tactical just means that we have to, you know, everything that we've heard so far means that things are looking really positive, at least on the near-term basis. On the longer term, is this going to move growth? Are we going to see a 5 or higher % GDP as a result of this? How do we learn about that? We learn about that when people, Chinese consumers, consume more. And do they feel empowered to do so? I think we'll learn that more in the weeks to come. And as of right now, I'm really encouraged to see many investors are bringing back their allocations just to a market level. I think what has happened, you know, historically is many investors have had an underweight to China. And what we're finding our clients do and ask us right now is this a time to perhaps move back just even to a market weight position? And that's what's going through the market with tickers such as FXI. The other thing that investors are doing is broadly allocating to EM equity. So even if many were moving away from EM sort of in the last couple of years because US was doing so well, this is a time to rethink EM, not just because of the China story, but broadly because of the cutting cycles, broadly because of reshoring, broadly because of many other demographic trends that are benefiting EM more broadly.
Are there specific parts of EM that you find more attractive, Gargi?
You know, we've talked for a long time, and if you look at our quarterly and even our mid-year outlook, we talked a lot about India as being an allocation that we think makes a lot of sense for the medium to long term. Again, this is an area where we're talking more about the longer-term impact of demographics, the longer-term impact on consumers being of an age where they can consume in a meaningful manner. We're talking a lot about infrastructure and the ability of infrastructure spending to sort of ramp up that consumption. So India is definitely a story. Obviously, there's been a little bit of underperformance recently, especially as some investors have moved away from India into China. But we think these present massive opportunities for investors.
Well, I am curious, when will it become easier for investors, and I'm probably talking about U.S. investors, to do that? It's funny when we talk a lot about the interest in China versus the interest in maybe other populations that could offer similar returns. A lot of people bring up the fact that, look, you've got FXI, you've got the K-Web, you've got a lot of products out there where you can easily invest in China. I don't know what you guys are doing there over at BlackRock. I'm sure you got something going on behind the scenes here, but when are we going to start to see more of a proliferation of ETFs and indexes that track what's going on in India?
I mean, look, we have INDA, which has had a tremendous year. Throughout the course of this year, we've had inflows, I would say, almost every week. We're over 10 billion in inflows. We've seen a little bit of outflows recently. So we absolutely have access for investors with tickers like INDA, with tickers like SMIN, that give you access to different parts of the India market, whether it be broad, whether it be small caps, et cetera. So that definitely exists. We want to have more and more investors start thinking about tactically and more bespoke investments into EM countries. So, EM often is thought of as a monolith. And this idea that there's things going on in Mexico and Brazil and India, and they're very different, and the central banks are different, and they'll provide different opportunities. So I think the iShares ETF franchise is actually giving you that ability that with the country ETF suite to do just that, and INDA and SMN give you that opportunity to do so.
All right, Gargi, always a wonderful conversation. Be well. Gargi Chaudhuri there. She's Chief Investment and Portfolio Strategist for the Americas at BlackRock, kicking us off to the close here on this Monday afternoon. When we come back, a closer look at Blackstone spinning off a new consultancy agency that promises to reinvent the way companies approach branding strategies. A discussion up ahead with the leaders behind FundamentalCo.
Plus, OPEC makes another cut in its global oil demand growth forecast. What that means for the commodities price as Brent crude settles below 80 again. And
Wedbush taking a less bearish view on financial platforms like a firm like Upstart. A conversation with one of those analysts up ahead in our top call segment. Stick with us. A lot coming up here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations. And we start off today with VF Corp, a downgrade to underweight today for the owner of Vans and the North Face. This is Wells Fargo makes its caution on apparel companies known. The analyst says VF Corp's valuation appears to be baking in much more upside than appears realistic, and the turnaround at Vans may not be as smooth as expected. The shares lower by 5% on the day. Next up, let's take a look at Caterpillar, lowered to underweight over at Morgan Stanley. While much of the market is calling for the bottoming of construction stocks, Morgan Stanley says otherwise. The analyst says demand may have peaked, inventories may have been overbuilt, and rising competition could be putting pressure on prices. Caterpillar shares under pressure today, down 2%, down below 394. And finally, an upgrade for Upstart. Wedbush lifting its rating to neutral, saying that the AI lending marketplace has a more balanced risk-reward profile. The analyst says improving credit quality metrics, lower interest rates, and improvements in the Upstart macro index could drive a positive inflection in originations, as well as adjusted EBITDA for the second half results for the year. Those shares up a whopping 18%, and those are some of our top calls. And we do want to stick on that last one. I'm pleased to say that the analyst behind it, he joins us right now. David Chiaverini is Managing Director and Equity Research Analyst over at Wedbush. He also upgraded buy now, pay later company Affirm to neutral today. All right, David, let's start with Upstart here, because this seems like a pretty compelling story when you talk about the balance of risk rewards. But I'm more curious about the growth going forward, the partnership that it has with Apple, and whether we can start to see meaningful uptick in growth on that platform.
Yeah, so for Upstart, a few things, and you summarized it well at the beginning, in that lower interest rates, I think that's going to lead to improving credit buyer demand going forward, because the cost of capital for these credit buyers, it gets lower. So they're able to buy more and improve their economics. And then looking at the Upstart macro index, that's been improving for the past few months. And that's a great leading indicator for originations looking forward. So given that their take rate has stayed elevated, we expect it to stay elevated for the next couple quarters, that should drive decent revenue growth over in the near term. So as long as their credit quality stays good, I think that this could be a decent grower for the next several quarters. Now, what we're going to pay particular attention to is credit quality after they accelerate this growth, because that's what got them into trouble a few years ago. So we'll be paying attention to that to see if they can keep their credit in check along with this growth.
What's the visibility, though, that they would have into that? And I guess for that matter, that you have into that particular side of the equation, because there's been so much, at least anecdotal evidence here about softness in certain pockets of the consumer space while there's strength in others. How easy is it going to be to determine credit quality?
Yeah, it's a good question. Back in the go-go days of 2021 and early 2022, Upstart was issuing many asset-backed securitizations, and we were able to track that data actually using the Bloomberg terminal. Now, given that interest rates increased and credit buyer demand pulled back, they pulled back significantly on the ABS issuance. So it will be a little bit more tricky to track the progress of their credit quality. Now, the most recent deal that they issued was in October of 2023, and that is performing more in line with expectations compared to the credit quality of the 2021 and 2022 vintages. Now, going forward, now that we are seeing a bit of a loosening in the credit markets, perhaps they do issue some new ABS deals, and then we'll be able to track the credit metrics through that. Otherwise, we do rely on the company's disclosures. They do put out in their investor deck each quarter how credit is performing, but we think a better objective view is using the ABS remittance data.
On a really granular, fundamental basis, David, it's a simple question, but like 25 basis points of cuts for the Fed, what is that worth in gross margin or margin for like a firm?
Yeah, so shifting over to a firm, when talking to the company with their messaging is that 100 basis point decline in rates should drive a 40 basis point improvement, all else being equal, in their revenue less transaction cost margin, the RLTC margin. Now, importantly, they say they want to maintain that RLTC margin between 3 and 4%. So to the extent it goes above the top end of it, they would look to reduce and loosen their underwriting standards to drive higher GMV growth. So they're willing to take on incremental credit costs in exchange for higher GMV, and that should lead to additional revenue growth on the bottom line.
How exposed is a firm to fluctuations within the consumer, or is it a different kind of a consumer structure for a firm, for example?
Yeah, they're definitely exposed to the consumer and consumer spending. Now, they've been able to grow through it over the past couple of years. What is helpful for them is that the duration of their loans are so short, they get paid back very quickly, and that's led to their credit metrics being much better than I otherwise would have expected. So they are exposed, but they're managing it well.
All right, David, thanks a lot. Really appreciate it. David Chiaverini over at Wedbush. It's interesting, though, because a firm, you can make an argument that it's not just like a lower-end consumer. It's across the spectrum, right? And so it's a different kind of thing than if you're just looking at, say, a lower-end credit card.
Yeah, and the thing, I was curious about the credit quality, though, because that's always been the knock on some of these companies, was like, how much due diligence are they doing into their customers in a way that maybe the traditional credit card companies are doing? And it's still a little bit of a black box. It's kind of like, just trust us, we got this all sorted out.
I haven't heard that before, right? It's so weird. We'll just see when there's another kind of downturn winds up happening about that. All right, coming up, we're going to talk to the leaders behind a new consultancy firm that's reshaping the investment world. A conversation with the leaders of FundamentalCo. That's coming up next. You definitely don't want to miss this. Want to learn more about Spanx, Oatly, Supergoop? This is the place to talk about it. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele, still on track for that 46th record close now for the year for the S&P.
I'm glad you're counting, Alex, because
making fun of me.
Actually, you know, it's so funny because I was looking at the number. You know, we're actually still well below where we were in 2021. We had 70 record highs that year.
70. Well, we're getting there. I mean, it's only, what day is it? Mid-August? Nope, October.
Mid-October.
Woohoo! All right, good deal. All right, let's turn from public markets.
We're gonna get Alex some coffee.
Just had it. Public markets to private equity. So Blackstone is reshaping the investment world with its consultancy spinoff named FundamentalCo. Now, the firm helps brands organize and develop new and exciting initiatives in order to propel them into the new chapter of their business. Well, here in the studio with more on all of this is Jonny Bauer, founder and CEO of FundamentalCo, Executive Creative Director Jenna Lyons, and Chung, Global Head of Consumer for Blackstone Growth. I was telling you guys, my first 5 group here on the table, so it's pretty exciting. Jonny, let me start with you. What are some of the brands that you've sort of taken to the next level, and how does that differ from like a regular agency marketing place?
First, thanks for having us all on today, and we're excited to talk about FundamentalCo. The core difference in which we operate is brand traditionally hasn't really had the right seat at the table in the investment context. And a common misperception of what the role of brand is, oh, it's an identity, it's a logo, maybe it's a little bit of messaging that you put in your advertising. And that's not how we see it at all. We actually see brand as a core set of ideas that you can organize an entire company around. And in the investment context, it can really take an investment thesis and translate that into a set of ideas and principles and actions that go well beyond just the marketing department. So they can include things like who we hire, what we make, what capabilities we have, how we organize ourselves, and tether a lot of different interventions to an aligned goal always of increased value creation.
So, Jenna, give us an example of something that some company that you guys worked with where you really elevated and changed a company.
I think probably the primary example that we'd love to talk about is Spanx, a brand that we all know and love, and most people have grown up with it. But I think they have come to be known as one thing. They were sort of marked as the shapewear company. And how did we take them out of that single category and get them to have, viability and also trust in another category, which is apparel and performance apparel.
You guys did the pants thing with them?
We've been really working with them to try and make sure that not only are they showing additional product, but they're also getting the credit that they deserve because their product actually has special attributes that not all apparel does. And so they actually were looking to us to help them branch through to that. So we took them all the way through concept and really explained to them, how can you stop doing some of the things you're doing, lean deeper into some other things that you're not doing, and then take that all the way to concept. So as Jonny mentioned, a lot of times people think of brand as just the look and feel or the picture, but this is more about the concept, how you execute the concept, and then how you take it all the way through to fruition so the customer really sees a holistic idea.
And it's the right context for when we're typically engaged at a chapter 2 moment. So obviously Spanx had been very successful as a shapewear company. Now became the moment for it to go beyond just shapewear into apparel. The kinds of questions that we would think through and discuss with them are, how is Spanx not just the best, but how is Spanx the only within the context of apparel? And what's a role that only it could play beyond its traditional shaping capabilities? So born of that comes, a lot of different strategies, including a product strategy, a new recruitment strategy, and then, of course, that'll be connected later to a new advertising strategy.
And this gets to the point, too, of longevity as well, particularly from an investment perspective, because we kind of know how fickle the consumer space can be, particularly when it comes to apparel and fashion. What's hot today isn't necessarily going to be hot 5 years from now. So how do you sort of, make that sort of bulletproof for investors where they can feel like if I invest in this company today, it's still going to be relevant 10, 15 years down the road?
Well, next year we'll celebrate Spanx's 25th anniversary, and we're working with this team here to think about how do we really make a splash out of 25 years. And it's lasted through a number of different economic cycles, a number of different fashion trends, and that was one of the key pillars when we were looking at an investment in Spanx with Sarah. I think for us, our work with FundamentalCo started even before we made our investments through the diligence process to really understand what could we unlock. Brand was a core piece of the investment thesis here. What ended up happening for us is we are really looking for, at Blackstone Growth, the next generation of household brands. We're looking for those brands with longevity and that they have the core tenets of being able to build and grow for the long term, not just a fad, not just here for a flash in the pan and then leave. And for us, the idea of using brand as a filter, as Jonny often says, rather than a wrapper, was really important for us to unlock how do you build that longevity in this brand.
Well, when we talk about this idea of sort of the next generation, are there sort of structural changes in our society and the way we live and the way we shop that is, providing you with certain opportunities, or at least the potential?
Absolutely. I think brands in the past were built off scale. If you had scale, you had power over retailers, you had power over national media buys, you had power over distributors. Today, because of the digital transformation, because of social media, because of just the advent of so much choice in front of us, all of that is different. And so how brands were built in the past are going to be completely different around how brands are going to be built in the future. You really have to focus in on great, amazing product. If you don't have great product, people won't come back. At Spanx, one of the core tenets is really around a core replenishment model, building products that people will come back for, having real key innovation. And FundamentalCo is really important imperative in helping us build some of these strategies with the team at hand.
Now, Blackstone is now a client of FundamentalCo, right?
Yes.
Okay, so what are you
right.
telling them they have to do?
I don't think I would tell Anne to do anything.
No, she's perfect, obviously.
She's doing a great job. But I do think it's nice to be able to partner. Having had the opportunity to work with them prior, we really do understand what it is that is the needs and how to actually incorporate the needs of the business from the outset. So as they're thinking about what to purchase, are we able to help and what kinds of things can we do to service them as they think about growth and as they think about shifting? What needs to get shifted? Can we be instrumental in assisting and really adding value, particularly as it relates to expanding the TAM? I think that's what everyone wants to do. Everyone wants to make their opportunity bigger. How do you do that? And you have to do that upstream. That cannot happen as an end result with just a brand and putting a pretty logo on it. It needs to really happen upstream. How do you actually integrate that? And I think one of the advantages that we have is, I've worked with inside a company. I know how hard it can be to have an agency come in and make recommendations. And sometimes the team looks at you and is like, I can't do that. And so we really do spend a great deal of time bringing the team along, making sure that they feel embedded and included in the process so that when they actually go to execute, there's real buy-in and a real understanding that we know how to do it, that we believe in them, and we know that we can actually help them execute the end goal.
That's a great point. And also, I think a lot of consultancies can operate with brand understanding or business understanding, but having spent time inside an investment firm has really helped us understand and add that investment layer to help come up with ideas that bring investors and portfolio company CEOs together. And we've been applying these practices and processes and structures that we've developed to organize our ideas from everything from power grid companies to payroll companies. We think it's applicable to a lot of different categories.
And on that point, Jenna, and I'm curious, given your background at J.Crew, you've kind of had the opportunity to kind of build a brand that already was established. You've also been involved with brands that kind of came from the ground up. As you move forward with this venture at FundamentalCo, do you think it's easier to start fresh, basically with the unknown and build that brand up, or start with something that is well known, maybe fell off, and build it back up?
I think it's a great question, and I would say it honestly, as it always does, depends on people. It's really a people game. It's belief in the product. It's a core idea. It's an idea that everyone can get around. I think where I see brands fall apart, and I have been witness very close up when those things happen, is when you start to lose the thread, when there starts to be too many different ideas and there isn't a central organizing idea. And so that can happen in a new brand or a very established brand.
All right, we're going to have to leave it there. Appreciate all three of you stopping by today. A great conversation and a really great concept here. Jonny Bauer is the founder and CEO of FundamentalCo, the executive creative director, Jenna Lyons, and Ann Chung, global head of consumer for Blackstone Growth. All right, when we come back after the break, we're going to take a closer look here at shares of Boeing have been under pressure once again after announcing a 10% cut in its global workforce. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. All right, it's time now for our stock of the hour and taking a closer look at shares of Boeing, taking another hit again today. This after the plane maker revealed plans to cut its global workforce by about 10%. That comes along with $5 billion in charges across two of its business divisions. Abigail Doolittle joining us right now, talk a little bit more about what's ailing Boeing, and I mean by what's ailing Boeing this week here. Yeah. So let's start with the job cuts, which we learned late Friday. They came out 10%, more than 17,000 people positions expected to be eliminated.
That's exactly correct, which, that's a pretty big hit for their workers. What's interesting is it is believed, at least I spoke to George Ferguson, our BI analyst, that some of those folks are union members. So this is one of the first shots across the bow that we've had from CEO Kelly Ortberg, because in the messaging around these job cuts, he also indicated that they may have to take more dramatic actions, or essentially more jobs could be cut, basically sending these union workers the message that we offered you a 25% raise, we offered you a 30% raise, you want this defined benefit package, and 40% you might not get at all. And by the way, we pre-announced it was a decent quarter so that we can now do an equity raise, $10 to $15 billion, which could help them last. We'll have that much cash to last, say, a quarter or two. How much cash will you have to last? How long can you last, especially if we have to continue to make this group sacrifice to keep the company going?
One of my questions is that the CEO on Friday also said in the press release that they want to focus on Boeing's core business, which led me to believe, does that mean that he thinks that there's some areas that's not core?
Well, they already closed down the 767 line. So the 737, that is the core business. Then it's the 787, and then it's the 777 or the 777. But they actually already closed down one of the lines, 767, which apparently that line is like less important. It's really been trickling down anyway. But that's another really important message to this union. By the way, if you happen to think that your job, you are a very valuable worker, you have skills that most Americans don't have, but, if you happen to be a part of this line, you no longer have a job, essentially.
Yeah, and this gets to a point, too, when we talk about core businesses, too. There's been a lot of speculation about what they do with the space business here. I mean, when are we going to get more of an articulation from Ortberg? I know he's new on the job, but when are we going to get more articulation of the longer-term plan?
I think that he probably, especially when you've given Elon Musk's SpaceX and that seeming growth with NASA, I think that that's going to be on the back burner for him. He has much bigger issues here to face, basically to get these planes back into production.
Gotcha.
All right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us on Boeing. Before we head to break, want to highlight a Sphere Entertainment here. The shares are spiking on the news from its website that it's going to make Abu Dhabi its next Sphere location. Ooh. Will it be round?
Well, I hope so, given that they're called the Sphere.
I mean, right?
But,
is everything made
I saw this thing in Vegas from outside. I didn't go inside of it. It's pretty impressive.
I heard it's really amazing, except when you have like a hotel room that like overlooks it, and then there's like flashing lights like all the time.
I couldn't get anything, but it's a spectacle and perfect for Vegas and probably perfect for Abu Dhabi.
There we go. Second venue potentially in Abu Dhabi in the UAE. All right, we're about 15 minutes away from the closing bells. We're going to count you down.
All right, we are just about 10 minutes away from those closing bells. Romain Bostic here alongside Alex Steele with an S&P 500. Alex, at yet another record high. So too, I'm told, is the Dow Jones Industrial Average.
It is true. NASDAQ 100 is not highest level, though, since July. But you know what also is at a record? NVIDIA. Who would have thunk that? NVIDIA at a record high again after that decline that we saw earlier in this year.
When in doubt, buy NVIDIA. That's been the mantra all year long.
I mean, I guess, but I guess are we just in a melt-up mode? Like, is this going to be a crash up? We're unwinding hedges from risk, and you're just going to, like, the risk trade is now to the upside? Is that what we're seeing?
I think we're getting a little bit of that. It'll be interesting to see whether the sentiment actually changes at all, given earnings season as it starts to ramp up. We don't get a whole lot of companies this week. Next week will be the real one, but we do get some big ones this week, including Goldman, Morgan Stanley, Netflix, and a few others, right?
Yep, at $4.6 trillion worth of market cap. Third busiest week.
All right, third busiest week here. And as we move closer to those closing bells here on this Monday afternoon, let's bring Darrell Cronk into the conversation, CIO of Wealth and Investment at Wells Fargo and Company and president of Wells Fargo Investment Institute. Darrell, great to have you here on the program. All right, as Alex said, I mean, we get a few $1 billion worth of market cap coming down the pike this week, obviously a lot more next week. So we're really going to learn how these companies perform, but more importantly, how these CEOs and CFOs view the next few quarters going forward here. Are you optimistic?
Yeah, we are optimistic, actually. And, I think you're getting the front-end loading from the financials with what's happening with the yield curve, and a steeper yield curve benefits financials. As we know, they love that type of environment. So that's kicking off along with just sales and trading activity at the big investment banks are paying dividends. I think if you back out from financials, though, that are front-end loaded, at the end of last week and this week, we are seeing a breadth of earnings growth widen, which is a healthy thing. But the quarter is still, if you take the consensus walking into the quarter, it's only for 4% earnings growth, down from 11 in the second quarter, right? Now, let's assume we beat by 400 basis points, which has been what we've been doing the last couple of quarters. You're still at 7-8%, which is about where we think earnings should grow. That's still a far cry, though, from 13% built in for fourth quarter and 15% for next year, right? So we've got to get not just earnings to hold and margins to hold here, but you've got to get an accelerant in the fourth quarter and into next year. Our thought is that those numbers probably actually get marked down. Not surprisingly, this is the time of year that sell-side analysts start coming to the realization that those bullish numbers might not make it there.
Do you think companies are going to have enough confidence and enough sort of visibility to provide any sort of tangible forecast for 2025?
They have been up to this point, but again, very early,
Yeah.
right? I think you're going to see this kind of air pocket of time here through the election where companies aren't going to be really wanting to commit to hiring, to CapEx, to some big long-term strategic decisions. But post that, right, assuming there's no major disruption, I do think that companies are comfortable heading into the 2025. They've started to really embrace kind of the soft landing narrative and that we won't end up with a recession. Therefore, I think you're starting to see that in the guidance going forward.
Wait a second. So we're waiting to see the markdown for earnings estimates for 2025, but we're also still waiting for money to come back into the market in the form of CapEx or hiring after the election? Am I reading you right?
Yeah, well, CapEx has been robust, certainly on the tech side, but it's been more anemic on the other elements. I do think you'll see some pent-up CapEx that hasn't been spent get adjusted into 2025. The real story, I think, that you've got to embrace here, or Wall Street needs to embrace, is you can't have your cake and eat it too, in the sense that you're going to get all these Fed interest rate cuts and still 15% earnings growth, right?
Right.
And so one of those two has to give. And I think you're starting to see the earnings cut numbers give in the Fed funds futures forwards. I think you'll have to still mark down that 15% earnings growth from next year to something a little more realistic, like 8 to 10%.
Okay, I got you. So still growth, just not where we see it. Do we also need to, though, mark down how many Fed cuts we're going to wind up seeing?
Yes.
To what? And what does that do in the market?
So we think you've still got 225s yet this year, and we think 75 next year. 75 worth of cuts, which is well below consensus, although consensus has come crashing down post CPI numbers last week and other, the strong jobs report and everything else that's thrown this debate in. Will the Fed cut in November? Will they not? We still think they need to, even though if you look at the rolling 3-month average of PCE, which is their preferred inflation measure, it's 1.7%. Right? It's below their 2 to 2.5% target. So between that and just the economy kind of slowing down marginally, not hitting a wall, not hitting a stopping point, we think the Fed should keep going with its cuts. It needs to bring that rate closer down to neutral, and we're well above neutral rate today.
And that gets to the point as to sort of what the market is pricing, and particularly in the fixed income space, because there seemed to be this euphoria that with rates coming down, that this was sort of this big tailwind. But if this is more the Fed just trying to effectively catch up with what the neutral rate is, or maybe where it's already went, is that really going to be a tailwind for stocks? I mean, no, we look at it in absolute levels with that rate down, but is that change really going to help?
It will help in absolute terms, but it will hurt on a relative basis because the relative expectations built into consensus are too high today and they need to come down. So the stock market's not going to get all of the easing that it wants out of the Fed. But that's not atypical, right? We walked into this year with 6 to 7 Fed rate cuts at the beginning of this year. Didn't happen, won't happen. In 2023, at the beginning of 23, we had 3 Fed rate cuts priced into the Fed funds future. Didn't happen, right? So it's very normal that the bond market gets some rationalization there. What's interesting is if you look at the long side of the curve continuing to grind higher, when the Fed cut rates in mid-September, September 18th, the 10-year was at 360, 365. Today it's at 410, right? So you've actually seen this material steepening, which again helps financials in certain industries, helps cyclicals in some ways.
It'd be remiss in not pointing out we're 3 weeks away from a major election here in the U.S. Without necessarily getting into who will win and who will lose, do you expect any major changes in policy come January when we get the inauguration of whoever the new president is?
That is the question, right? So I think depending on who wins, right, it's a coin flip for the executive branch. We think the Senate goes GOP, and the House probably rides the coattails of whoever wins the executive branch on a slight margin, one way or the other. I think tariffs are the big one that you have to watch, right? It's the one that's controlled by the executive branch, doesn't need congressional approval for 301 tariffs. And so the ability to go in, and we know that particularly former President Trump has been very outspoken about what he wants to do with tariffs, right? Maybe Harris a little less so. But both are going to take a much, if you were to look at this election and said, what are 2 certainties that you see on the other side, regardless of the candidate, I would say higher tariffs, and I would say more fiscal spend. Right? Both candidates are continuing down those paths, right?
Yeah.
So.
All right, Darrell, we have to leave it there. Always appreciate you taking time for us. Darrell Cronk is the CIO of Wealth and Investment at Wells Fargo & Co. and president of Wells Fargo Investment Institute, helping us count you down to the closing bells here on this Monday afternoon with the S&P 500, Alex, at a record high.
Yeah, what's going to be interesting, though, is if you take any kind of hedges or risk off after the election, do you get kind of a melt up? Because maybe nothing big changed, maybe nothing dramatic happened, and then you get a melt up in stocks.
All right, a full breakdown of all your market coverage coming up in just a second, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through the closing bell. A global simulcast starts right now. We're joined by Carol Massar and Tim Stenovic in the radio booth. Scarlett Fu out for the day as we welcome our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. A day where we see equities once again reaching for another record high. We should point out bond markets closed here for the Columbus Indigenous Day holiday.
Yeah, good to point that out. And having said that, in terms of what's helping some of the momentum to the upside, take a look at the semiconductor space, guys. The SOX, it is definitely showing some outperformance. There's 30 names in the index, 27 are higher today. I'm going to talk a little bit about NVIDIA in just a moment, but the index, Tim, is up about 1.8%.
I didn't know anyone was even trading today. Like, were you guys out in New York City today on your way to work?
No.
Yes, like I was out.
Completely empty. The city completely empty. It was just me and the tourists out there.
No,
I don't know. It still took me 35 minutes to get to work in a car, so I don't know about that one.
Really?
Yeah.
Oh,
He took Flatbush, though. That was a whole different thing. But
yeah. Okay.
Flatbush.
Yeah.
It only took me a half hour, Alex. I came
okay,
later
fine.
than you, so
Don't you guys live close to each other? Shouldn't you be carpooling or something?
That was my indication that nobody is in the city right now. So.
That's a good talk. But I think so your point is you don't believe what this rally is then in the equity market. You're like, forget it. No one's trading. Who cares?
I'm looking at volume compared to over the last 20 days. We're down on the S&P 500 by 13.4%. So nothing to shake a stick at.
Okay, well, nothing to shake a stick at here, but we do get the clapping and the cheering here on this Monday afternoon.
We're here.
As the closing bells ring, and yes, you see record highs across the board, at least for a couple of the big indices here. The Dow Jones Industrial Average going to finish higher by more than 200 points above the 43,000 mark, up about 0.5% on the day, and that is a record high. The S&P also closing out at a record high right around 5860, up about 0.8% on the day. The Nasdaq Composite shy of its record high, but still higher on the day by about 0.9%. But let's take a look at the small cap space because we are starting to see a bit of a catch up here. The Russell 2000 closing out right around that 2248 level. So it's still about 10% from reclaiming that all-time high, but continuing to inch closer towards that with a 0.6% gain here on the day. And the S&P 400 mid caps also up about 0.6%, and they are closing at a fresh record high.
All right, guys. Yep, there you have it. And taking a look inside the S&P 500, you got most names higher today, Romaine, about 403 to the upside. Alex, just 100 losing ground today. So definitely fairly, I guess I should say, or definitely or fairly, whatever you want to do, pretty broad-based in terms of a move to the upside.
All right, I'm taking a look at the IMAP function here, guys. It's definitely a pesto pie. Only energy barely in the red, and consumer discretionary, even in the upside, actually. That's up by 0.2%. But the outperformance is in information technology as well as financials continuing to deliver as that curve continues to steepen, although bond market's definitely closed today. But I think the point is this is a risk on day, full stop, period. Goodbye.
That's a lot of green. All right, which means I had a lot of choices here today. NVIDIA looks like it's at a new record, gaining 2.4%, highest level on record. Stock closing at $138.07 a share, and that's the first record close since June. It does remain below an intraday peak. It is the second best performer in the S&P 500 this year. We know that we've had comments from Jensen Huang, the CEO of NVIDIA, talking about the Blackwell chip over the last week or two. In full production, the demand for it is insane. So there's a lot of analyst commentary out on NVIDIA in particular about the business, the media. I mean, he is doing a lot of media, I should say, whether it's podcast, traditional business media, traditional media. Anyway, this
is he running for president?
No 60-minute. Oh, actually, he did. Didn't he do a 60-minute interview?
I mean, maybe. He is still selling something, right?
Yeah.
He's selling a lot of stuff. All right. Anyway, so NVIDIA definitely an outperformer here. B. Riley, check this one out, guys. Up 23% at its highs today, up more than 32%. Money losing broker, dealer, and investment firm agreeing to sell a majority stake in its Great American Holdings business to funds managed by Oak Tree Capital Management. This one has been in the news a lot, so investors certainly happy about that sale. Stock closing at $5.42 a share. And then an AI play, Big Bear AI, soaring just off its highs of the session, up almost 19% though here at the close. It's an AI solutions provider, announced that it was awarded a 5-year, $165 million sole source prime contract for global force information management production services from the U.S. Army. So investors like that news, sending that higher.
Okay, you had a lot of choices.
I did.
Me, not so much. I do want to start with shares of Boeing, down 1.3% today. It's the first trading day since the company announced it would cut its global workforce by about 10%. They did that after the bell on Friday. Never a good sign when news drops them. Then they announced a $5 billion charge to their commercial airplanes and defense business as well. Shares fell as much as 3.3% earlier in the session, did hit a 52-week low, actually almost a 2-year low going back to November of 2022. Shares down 43% so far this year. Looking at shares of Caterpillar, down 2% today. An analyst call sending shares lower today. Morgan Stanley downgrades the stock to underweight. Analysts cautious on construction firms, flagging a disconnect between fundamentals and a share price. Once again, shares falling today by a little over 2%. And finally, the NASDAQ Golden Dragon China Index fell 2% as well today. Keeping an eye on what shares of, what ADRs of Chinese companies are doing. Most recent stimulus news out of China over the weekend. Also, quite a bit of data coming out, including China's loan expansion disappointing last month in a sign of still weak domestic demand, even though credit growth exceeded expectations, thanks largely to a surge in government bond sales.
I wonder if this is also just sort of, ooh, if I say lazy investing, is that bad? That like understanding the nuances, right? Of like, we have to help local government debt. We have to help housing. It's not about just cutting checks to people to buy TVs, right? Like there's a nuance there. So you just can't go like buy a blanket stock index that relates to Chinese equities.
Right. Targeted stimulus, right?
Yeah. All right. Anyway. Okay. That was my point. Yeah.
Good point. Good point. I'm thinking with maybe some people taking the day off. We've talked about it being a little bit mellow. Maybe they're going to one of the games that they're, I don't know. We have quite a choice tonight. You've got what? The Yankees, the Mets playing. You also have the Jets playing. We're calling it a trifecta. I think you even have a hockey game tonight.
I think you got to go to LA for the Mets game.
All right, so maybe you left on Friday or Saturday.
But the whole point is like, how do you know what to watch?
Some people are doing it. Although after last night's Dodgers-Mets game,
are you traumatized by that?
What was it, 8-0, guys?
9.
9-0?
Yeah.
Wait, do you even care?
I got the score wrong, but it was close, 9-0. I don't know.
Anyway, are any of these teams good?
What's that? The Mets are great this year.
Are they? Okay.
Oh, yeah.
All right, cool.
Mets are great.
Yeah. I think that was the point because it was so painful yesterday. But that's what I'm saying. It's like they're staggered, right? Isn't the Mets at like 4 o'clock or something? So
Mets at 4. Then you've got the Yankees at like 7:30ish, and then I got to see what time the Jets are. The Jets are at what 8:15 p.m. So yeah, there's maybe staggered.
Okay.
Okay, but you know, if you want to stay up for all those, maybe you go to Starbucks, you get a snack, you get a coffee. Guess what, guys? You may not be getting a discount with that. So this comes from the Wall Street Journal. Apparently, Starbucks is pulling back on promotions and discounts. This is an early move by Brian Niccol, the new chief executive officer, to reposition that coffee chain after a very stressed year. He took the helm back in August, and they're quietly reducing those discounts. Can I be totally honest with you? I didn't know they had discounts.
I was just going to say the same thing. I had no idea.
You gotta have to be like a special top secret member or something to get those discounts.
Like loyalty points and
you got to be
right?
on the app. And you gotta do all
Wait,
that,
so you get the
blah,
discounts?
Blah.
We don't drink coffee.
I don't drink coffee, so I don't really
They were
care
the buy one, get
other.
one certain days, I think.
Well, yeah. I mean, it's fine. I mean, if you go in there and you get your, triple, pump, rainbow iced tea with the marshmallows on top. Not that I've ever ordered that, but if you were to order that, yeah, you can get discounts if you go enough.
It's interesting, though, in this story, they talk about how, like, Starbucks always put themselves out, right, as a premium brand. I think that's why I don't think any of us thought there was discounting, right? Like, here's what we do, pay for it, kind of the full price.
So I guess this is the early part of what Brian Niccol's doing to sort of transform the chain, to turn it around.
So we've pretty much established none of us actually go to Starbucks.
No,
right?
I go to Starbucks all the time. I just had no reason to believe they were like packages. Apparently, I could have gotten a drink and a breakfast for $5.
There you go. I smell a class action lawsuit.
Bummer.
Yeah.
How did I not know? Well, I don't know. Maybe he's just trying to streamline things. We'll have to see as he builds up.
I'm all for this, though. though. I mean, all seriousness, though. I mean, and we've talked a lot about this. The idea that when you get into this sort of vortex of discounts, it's hard to pull yourself out of it. Just ask Bed Bath & Beyond. And sometimes you just have to hold the ground and saying, look, the price is the price. It doesn't mean that there can't be promotions from time to time, but if you make that perpetual, you'll never get out from under it.
Don't mess with my Bed Bath & Beyond coupons.
Don't forget.
I got to break it to you. Your Bed Bath & Beyond coupons are zero. Squadouche.
It's not going to work.
Yeah.
But you can actually buy stuff, right? And then you're like, oh, I forgot my coupons, and then come back, and then they apply them. Like, it was crazy.
Isn't that part of the problem? Like,
I wonder why they're not around anymore.
Absolutely, absolutely.
Hey, guys, the last thing I'll say about Starbucks and Brian Niccol, don't forget Brian Niccol was the guy who brought the Doritos Locos Taco to Taco Bell.
Yes.
So we'll see what he does in terms of menu innovation.
What's your point?
At Starbucks.
Yeah, do we like that?
What are you saying? You want a Doritos Locos latte? Is
Yeah,
that what you're pushing for?
Oh.
There's no way Tim Senevic would ever let that pass.
Frito-Lay.
That square jaw of his. So.
I guess we got to go.
It is, right? It's a good one. All right, that's a wrap. Our cross-platform.
I aspire to be Tim Senevic.
It's like Superman, right? Clark Kent?
Why are you
What are we
covering
talking
it?
about?
What are you doing?
All right, radio, TV, YouTube, Bloomberg Originals. That's the Monday edition, our cross-platform. We will see you again, same time, same place tomorrow, guys.
All right, coming up, a lot more coverage coming up here on Bloomberg Television, including a closer look at the oil market with OPEC cutting its demand growth forecast for a third month. A discussion up ahead with Amrita, founder and director of research over at Energy Aspects. This is The Close on Bloomberg.
Happy Monday. Welcome to The Close. I'm Alex Steele.
And I'm Romaine Bostic. Another wild day on Wall Street, but it was for gain here on this day. A 46 record high for the S&P 500, up about 0.8%. Big outperformance by big cap tech, including the Mag 7. It was kind of interesting, too, because we talk about the idea of maybe a potential broadening of this rally. We saw risk appetite. You see that reflected in the jump that we saw in Bitcoin. But, of course, a lot of pockets out there still under pressure, including with the insurers, the NASDAQ Insurer Index. One of the laggards here on the day, Alex Steele.
All right, taking a look at some individual names, right? I was going to put NVIDIA on the list, and I took it out, but NVIDIA definitely hit a record high right at the close. But the reason I went with Wells Fargo is it's continuing its rally from earnings on Friday, now at the highest level since 2018. Then you have United reporting tomorrow, and that stock is up almost 3%. Analysts are looking for the carrier to grow as much as 6% in the fourth quarter, even though rivals are trimming their flying, and that's going to help push these fares higher for United. And the reason why I bring these two stocks up, it just shows how important earnings is to the stock market right now. And to this point, this shows the quarterly earnings estimates year on year. The blue lines are the expectations, right? This is where we've been. This is the expectation. And this is the quarter that we're looking at right now. So we're looking up just like a couple percentage points. Bloomberg Intelligence pointed out, though, if you take a look at guidance from companies, they're expecting 16% earnings growth. That very much differs with this 3+% that we're seeing from analysts. And this is going to be our top story over the next hours. How do we square that? Is it easy bar to beat no matter who's going to be delivering? Or are we going to see some disappointing numbers coming from companies that doesn't justify this 3% growth from AIM?
Absolutely. A question, of course, that we will take some time to answer. But before we do that, we do want to turn to the commodity market. A closer look here at where oil ended the day, falling after China's highly anticipated briefing lacked new incentives that investors say would boost consumption. Amrita is the founder and director of research at Energy Aspects, and pleased to say she joins us live here in New York in Studio 2. Great to see you in person.
Thank you. Likewise. Great to be here.
Let's talk about the demand story, particularly when it comes to the world's second largest economy. What is that demand?
The good news is that the worst is behind us, but the bad news is it's a pretty low base we are coming off, right? So I think that's why the market was looking to more stimulus. The monetary policy, as it's been called, the bazooka that they did a couple of weeks ago, very important because until then, the market had been very disappointed with any kind of stimulus measures from either fiscal or monetary. So I think that's been positive, but the market was expecting more. It's not that they've closed the doors, right? They're not saying no more. They're just saying they've punted it to later on in the end of October, kind of when they have the big meeting, or next year. So it is still going to be positive. It's just going to be slow, and it's going to be gradual.
When we look at global demand and you take a sort of a look at the OPEC reducing its demand forecast, which wasn't unexpected, but I think the fact that this has now occurred 3 times in a row, more or less here, has definitely raised some eyebrows here. What is the global demand picture, even taking into account the softness in China?
I think without China, the global demand picture isn't particularly rosy. I mean, our demand numbers this year is less than 1 million barrels per day. It's about 0.8, so it's a lot lower than OPEC's numbers. And we have been flagging, I think, single biggest reason why oil prices are where they are today, because they're not justified by the low inventories. The inventories are low everywhere. It is this demand weakness and the fear that this is going to continue. And, people are talking about peak demand, which I don't necessarily agree with yet, but it's that fear and the China narrative that's really capturing the market.
So then here's my question. If I look at, say, Brent at, 77, is that taking into account geopolitical risk, as in the demand picture is so much weaker that, it should be a lot lower, or are we totally ignoring the geopolitical risk?
I think it's the latter, not totally ignoring it. I think maybe prices would have been lower still if it wasn't for some of that risk premium. But, think about it, even a couple of months ago, forget years ago, we would probably be $120 given where Israel-Iran is. Yeah.
So why is that?
I think it literally just goes back to the fear about demand. People are telling me, there's not going to be any demand growth, which I disagree with. Now, with the Fed cutting, it's not about U.S. growth. It's about what it does to emerging market. Emerging market is going to be stronger next year. Even China's measures, yes, it's going to be slow, but it is going to be better next year. And nobody wants to talk about non-OPEC supply growth, which has been very, very weak this year. And then they're kind of getting themselves into this tizzy around, demand is weak and OPEC's going to bring back barrels. It must be bearish. It doesn't matter if we lose Iranian production.
Let's talk a little bit more about the supply side of this. So when we talk about non-OPEC supply, I assume partly you're talking about the U.S.
Yes.
Does that change at all, particularly given that we are in an election cycle where at least one candidate seems to have made clear that he would probably want to open up the spigots a little bit more here? Is there any potential that we could see a meaningful increase in supply coming out of the U.S.?
I think the one thing, regardless of who wins and regardless what the political views are over here, that's not going to change is U.S. production growth in the short term. Because all the producers are already doing what they can. Sure, there'll be some permits on federal land, but that's a medium-term story. The strip, WTI strip, more or less this year has been above $75. So this is not a price issue. So I just got back from Houston, and all the Permian producers are also saying to us, we're running out of the best quality acreage. They will continue to produce, but it's getting more expensive. It's getting gassier. If you look at the northern basins, Bakken, Anadarko, they're all down year on year this year.
And so that's interesting and ties into the geopolitical risk, too, because the thesis is, you know what? If something happens with an outage, no problem, because the U.S. is the biggest producer in the world. But if they can't live up to the expectation everyone had, then it does become an issue. Typically, technology solves it. If prices are high enough, the technology becomes super cool, and the shale players do something super cool. Is that going to happen this time?
I think they're struggling. Not that there won't be technological innovations. I really believe ultimately we're going to get more and more. But I think what we are seeing is that we've done the most of it, and now it's incrementally small things. Also remember, there is a lot of consolidation going on, and what we see with consolidation is the bigger company tends to just get rid of the less efficient rig. They're just not drilling in those areas, and I think that is going to be the new normal. I really, really do believe the market needs to see a couple of years where you don't get much growth, you actually see a supply outage, and then they'll rebase it, because they've just been too badly burned trading geopolitics, and it's actually not materialized in terms of higher prices.
So then for companies, are they also spending a lot of money on green technology and other technology, and they just can't spend on everything at one point? Is that a story here?
For some companies, yes, because there is still, ESG, by the way, is becoming less of a burden to an extent, but it is still a big focus for a lot of companies. Look at the amount of money being spent on CCUS, or for that matter, gas capturing. You have to reduce flaring, and that's the problem. If your acreage becomes more and more gassy, you need to put in a lot more money to capture that.
Right. And CCUS is carbon capture, utilization, and storage. I got you. All right. I think we're bearing the lead here, guys, because Amrita doesn't drink coffee either. So I'm literally sitting on set with two people who don't drink coffee, and I'm scared.
We are aliens.
I don't understand these people. Yeah. Amrita, good to see you, as always, in person. Amrita Sen, founder and director of research over at Energy Aspects. All right, coming up, the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. All right, time now for the top three, where we name drop the people driving some of today's most talked about stories. First up, Elliott Hill. Today is Hill's first day on the job as Nike CEO. And we were writing about in Bloomberg Business Week how it's interesting that today's roster looks a lot like 2019. Because apparently, remember, Hill returns to Nike after having spent more than 30 years there. And the last time he was there was, guess what? 2019.
Yeah, and I think there are a lot of people that are looking kind of at the tenure of Donahoe and basically saying that, maybe that was a misstep in hindsight. The idea here that they were so hyper-focused on those numbers, so hyper-focused on the balance sheet and everything else that they kind of lost sight that at the end of the day, they're still an apparel and fashion company, and you got to be innovative, you got to be creative, and without that, you lose customers.
We should have asked the FundamentalCo people about that.
I know. Well, maybe that could be one of their next clients.
We
here.
totally missed a trick on that one.
All right. Well, speaking of sports here, I'm actually keeping an eye, on a couple of different people. Billy Crystal and Spike Lee. They were actually inducted into the Basketball Hall of Fame. I don't know if you know this, Alex. I know you're a huge sports ball person. But the Basketball Hall of Fame has a super fan section. Now, of course, Billy Crystal, a longtime L.A. Clippers fan, and he would always be there on the sidelines as well as at Lakers games as well. And, of course, Spike Lee, who always makes himself known over there on the sidelines of the New York Knicks and now of the New York Liberty. Both of those men are being inducted, I should say, into the National Basketball Hall of Fame.
Wait, so what is that? I've never heard of this before. That there's a fan thing of this?
Super fans, yes.
Well, what about is there an equivalent for things I like to do? Like shopping?
Yeah, I think it's in the basement.
Yeah, all right, fair enough. All right, and finishing off our third here is Elon Musk. So Tesla apparently used humans to remotely control some capabilities of its Optimus robot prototypes at a recent event. That's according to people familiar with the matter. I was not entirely surprised. Should I have been surprised at this?
No, you weren't surprised. I wasn't surprised. In fact, when they were doing this, I said to myself, I wonder if there's a human operating this. And I thought the human was inside the thing, but apparently it was a little bit more complicated than that. Ed Ludlow joining us right now, who actually just wrote a story all about exactly what went down at this event. And Ed, so just explain this to me like I'm a 5-year-old, because when I saw the Optimus, we all kind of thought back to a couple years ago when he brought one of these bots out, and we later learned it was a human being in there just acting like a robot. There was no human being inside the suit, but there was somebody off to the side apparently controlling that. Is that what you learned?
Correct, and these were real robots, but you're completely right that there was just so much speculation on the night itself, but particularly from the sell-side analyst community and investor community that were there, that I just wanted to confirm it. So we are reporting, citing sources, that yes, in most cases, what you were seeing was teleoperation by a Tesla member of staff. In some cases, the robot was acting autonomously, but that was kind of limited to walking around. And the bit that's kind of new is that I was told by a source that Musk basically decided 3 weeks before the event that he wanted the robots there. And that left the team scrambling because the robots weren't ready. The software was not ready. The hardware's good. That's real, Romain, what you're looking at. Yeah. But the software is not yet ready for it to operate autonomously. And so teleoperation, according to my source, was the only option they had. And I just wanted to set the record straight on that.
So when you say that they could do things on their own and they're walking on their own, that's their programming, that's like Terminator stuff?
Exactly. So this was at the Warner Brothers lot, right? It's a really big facility and it was a big crowd. So while they're walking, they are able to sort of control their motor function themselves. There are some images, I don't know if we have them, of them dancing and mimicking dancing. Some of that is artificially intelligent. Yeah. But what you're seeing there, handing stuff to people, pouring drinks, teleoperation.
And we should point out, I don't want to just rag too much on Musk and Tesla, but we should point out Boston Dynamics and a lot of other companies have shown prototypes of robots that can actually do things autonomously. And it raises a lot of questions, Ed, not so much about the viability of this long term, because I think we all can see the promise in this. But as to the way that Tesla is representing this, and it wasn't just the robots, but also either the Cybercab or the van, maybe you can explain it to me. Correct. We also learned that there might have actually been some human involvement in getting those things to move in the way that they did.
Yeah, so one reason that Optimus is important and the reporting we just did is important is investors were left profoundly disappointed that they didn't hear more about a future ride-hailing business model. That's why the stock fell 10% Friday. So their main takeaway was Optimus. Then they were disappointed to find out the robots were being teleoperated. What I've learned is that the vehicles on Thursday, the robotaxis, were fully autonomous. There was a team standing by, according to my sources, to jump in the event that they were needed, but they didn't. The whole night ran successfully and smoothly. The frustration of investors is like Elon didn't really say anything that answered their questions. And what I just heard from sources is he was supposed to, but he cut 75% of his presentation out. He was going to talk about pricing.
Yeah.
He was going to talk about the roadmap for software for the semi-truck. He was going to show images of the app for ride-hailing. None of it made it to air on stage. And so investors were left wanting more.
Yeah, and this seems to be a kind of a story with them. Obviously, a guy who really knows how to overpromise. But the question is here, when do you deliver and how do you deliver it? Obviously, a lesson either he hasn't learned or maybe more appropriately just doesn't care about. Ed Lowe, of course, who has been tracking this story for us. A closer look here. That big Tesla robotics event. Were you watching this thing?
I did not watch it.
Okay, all right. Well, you missed a lot.
I did.
Apparently.
Yeah, the robot.
Yeah.
You thought there was someone inside it? How skinny would that person have to be?
I don't know. I don't put anything past them these days here, but I don't know. Little anorexic robot? I don't know. All right, when we come back, we're going to take a look back at this day in history and Nobel Prize awards. All right, the Nobel Prize for Economics was announced today for a trio of economists and their analysis of prosperity and inequality. So it's fitting that we devote today's On This Day segment to another trio of Nobel winners, the economists Eugene Fama, Robert Shiller, and Lars Peter Hansen, who shared the 2013 prize for their research on how financial markets work. Now, it's hard to understate the impact their research has had on Wall Street. Long before they ever won the prize, the three effectively laid the foundation for the current understanding of asset prices. And that all began with findings by Eugene Fama that it's difficult, if not impossible, to predict price movements in the short run. It was a conclusion that formed the backbone of the efficient market hypothesis. In a nutshell, Fama argued that stock price movements are unpredictable and follow a random walk that makes it impossible for any investor to have a meaningful advantage over another. That theory gave rise to low-cost equity index funds and even lower-cost equity ETFs, ways to share in market gains without trying to beat them. There is not a single person who earned a finance degree, an MBA, a CFA, or any similar credential over the past 50 years who didn't have to study and parse Fama's theories. But if you disagreed with Fama, you weren't alone. The Nobel Committee that year, in a flare of irony, made Fama share the award with one of its biggest critics, Yale University's Robert Shiller, whose research focused on longer-run price swings and the extent to which they could be explained by fundamentals such as dividend payouts. Shiller, famously using the phrase irrational exuberance to explain run-ups in asset prices, distinctly took issue with Fama's arguments that investors are logical. Essentially, the Nobel was given to the founder of efficient market theory and to the man who spent a career poking holes in said theory. Robert Solow, a Nobel winner himself, told Bloomberg back in 2013 that Shiller and Fama sharing that award, that was like making the Yankees and Red Sox co-champions. And now, as for Lars Peter Hansen, the University of Chicago professor, was largely viewed as a counterweight to them. His work included the development of techniques for analyzing asset prices in a way that one could test various theories on what drives markets. Now, unfortunately, decades later, those tests have proved inconclusive. Alex?
I love those On This Day. That was fascinating. I learned a lot on that. Our top story for the hour is earnings. And the trio to keep an eye on this week, Citigroup, Goldman Sachs, and Bank of America, the three big banks set to release results tomorrow. That's after JP Morgan and Wells Fargo beat expectations. You're also taking a look at the KBW Bank Index, for example. That's up by over 4% in those 2 days. Joining us now to discuss, Betsy Graseck, Morgan Stanley Managing Director and Global Head of Banks and Diversified Finance Research. We have so much ground to cover, Betsy. Obviously, we're going to leave Morgan Stanley out of it, but what can we expect, say, from Goldman as well as Citigroup and Bank of America?
Oh, well, thanks so much, Alex. And just to set the stage, as you indicated, both JPM and Wells Fargo beat estimates. JPM by 10%, Wells Fargo by 13%. That's our estimates. We were close to consensus, so it's similar. And that beat in JPM in particular came from a wide range of business lines. But when we drill down into the revenue mix, the beats in revenue were in particular high in the business lines, commercial and investment banking, right, for that business line. And within that, where the beats came from is in debt underwriting in particular, merger and acquisition advice, the advisory line. Also, expenses came in nicely, a little bit lower than expected. So for the firm overall. But basically, when you drill down into those revenues and where the revenues really beat most strongly, it's in your capital markets activity. So as we think about Wells Fargo, too, there was an 11-cent beat on revenues, 7 cents of which came from trading. So you had both in JP and Wells on Friday, capital markets really driving a significant amount of the revenue beat. And when we think about tomorrow, Goldman Sachs clearly has the business model that is most skewed to these beats. And we do come in a little bit above consensus on the underwriting side because September and the end of September was very strong.
Fair enough. The other part, though, is net interest income, and that is squarely going to be put into the consumer banking part. Not squarely, but that could be part of the consumer banking part, et cetera. And net interest income was actually pretty good. Did you expect that to also be the case for the rest of the big banks coming out?
So it definitely depends on what where you're getting your deposits from and what you're investing in. So every bank's a little bit different, but just broad strokes, we are a little bit more positive going into the rest of this week than going into Friday. I thought, there might be a little more NII discussion in the calls on Friday, but given how strong capital markets was, it really overshadowed. And then just lastly, as you well know, the Fed only lowered rates a few weeks back. It's too late in the quarter to have an impact on the quarter. So let's think about what the forwards are. Really, I think the NII discussion will ramp up as we go through the next 2-3 quarters.
I sort of chuckled when you said that. I'm sure you must have heard Jamie Dimon's comments here. I mean, he's sick of all you analysts asking him about NII. And he's, all jokes aside, I mean, he gets to a larger point here, too. I mean, investors are really honed in, I think, for just more signs of more activity at these banks, whether it's on the consumer side, the corporate side, the investment side here. Is there a sense here that investors have appropriately priced these stocks now, or do you think there's still more room to go?
Well, we do have an attractive view on large cap banks, and in particular, the capital market sensitive names, largely because we do think there is more earnings generation likely ahead as, number one, the Fed cuts rates and capital market activity expands further. That's one of the key reasons for being overweight the large cap banks. And then the second part is as rates come down and the yield curve de-inverts, if I can use that word, it should drive more demand for front-end lending, which is C&I, which is a quarter of the book of the bank. So we do anticipate more activity going forward.
Do you worry at all about any of the potentially new capital requirement rules? Obviously, you still got the Basel III endgame, which I think started like back in the 1800s. But at some point, that'll be resolved. And there's been a lot of talk, of course, about the private capital industry kind of stealing some of the lending thunder from the banks here. Can there still be meaningful loan book growth in this environment?
I believe yes, but that is with a lot of, reasons why. So number one, when we think about just on average over time, bank lending should be similar to nominal GDP. And as you well know, it's below right now. One of the key reasons is we have an inverted yield curve, and private equity has come in, private credit has come in, I should say, to offer to medium-sized businesses term loans. And that it does give medium-sized businesses the ability to borrow cheaper And so as the curve de-inverts, that will be an important element for reducing that relative advantage that a term loan currently has over a C&I revolver. But there's more we could talk about this, and I'm happy to come back and dig in if you'd like.
No, you have to. You have to come back like every day so we can go through all the different parts. You cover literally anything that covers money. Just before we let you go, in terms of, say, the regional banks, you mentioned capital markets being so outstanding, and that bodes well for Goldman. But for the regional banks, they're not going to have that. So it's really going to be about net interest income. Do you have a favorite in this space, and what are we looking at?
So my colleague, Manan Gosalia, does cover the regional banks for us, and he is also attractive that group. And, he likes MTB, for example. So I'll speak on his behalf, and you should have him on the show to go through his thoughts and views. From my coverage, we are, attractive to large cap banks as well.
All right, Betsy, going to have to leave it there. Always appreciate you taking time for us. One of the best in the business, Betsy Graseck, over at Morgan Stanley. A closer look here at the earnings coming out of the big banks. Meanwhile, we are getting some preliminary earnings report. This out of the beauty company, Coty. The company basically guiding folks a little bit lower, saying that preliminary sales for its fiscal first quarter only grew about 4 to 5%. It had seen growth of about 6% prior to its latest update. The company said second quarter sales on a like-for-like basis will grow moderately, though it does not provide a hard number there. It does say for the full fiscal year, it sees adjusted EBITDA up about 9 to 11% year over year. Not quite sure what that comparison is, but you see the reaction in the shares, down 4% here in after-hours trading.
Yeah, they really highlight U.S. market growth has slowed in the second half of the first quarter for them. Invest in your face. I still say it, but maybe not necessarily happening right now in the U.S. All right, let's look at how markets closed on the day here. The S&P closing at 46. Yes, I am counting a record high. The NASDAQ at its highest since July. Mid-caps also hitting another record, and NVIDIA at a record high as well. I feel like it was this stealth rally on, no big, huge catalyst necessarily, but just continued AI story.
It's NVIDIA's world, Alex.
We're just living in it, straight up. Yes, this is the close on Bloomberg.
All right, Goldman Sachs, one of the biggest banks in the world's largest economy, upgrading its forecast for the second largest economy, saying China's economic growth for this year and next should be better than expected after Beijing unveiled a series of measures to promote growth. The upgrade coming as economists and investors assess the potential impact of that push to boost an economy facing weak sentiment and persistent deflationary pressures. To share his perspective is Ajay Rajadhyaksha. He's Barclays Global Chairman of Research. Pleased to say he joins us right now. And let's start, Ajay, here with some of these stimulus measures, if you will. We heard a little bit about this about a couple of weeks ago. We got an update shortly after that and an update this weekend. The general consensus, at least among investors, is that they wanted more. Do we need more?
I think it's not so much that investors wanted more. They wanted a hard dollar or a hard renminbi number on it. And that they haven't gotten. They did not get that on the 24th. They did not get that on the 26th. They did not get that on Saturday. And, the numbers that are being tossed around anywhere between 6 to 10 trillion renminbi of extra spending. That's what investors want to hear. And so far, the Chinese are talking in the right way. They're talking about recapitalizing their banks. They're talking about buying unsold properties, supporting their consumer, but they're not mentioning hard numbers. That is the disconnect.
There's a disconnect with those hard numbers. I'm just going to play devil's advocate. There are a lot of people that say that what China's doing right now is probably a lot more prudent than what they would do in the past, where they would just open up this fire hose of cash, pump it into the property market and other areas, and hope for the best. We've seen the results of that, and it's not always good. Do you have some confidence that the strategy they're taking right now, longer term, might be more beneficial to this economy than investors are giving them credit for?
No question. I mean, you're absolutely right. They have done far bigger stimulus programs in the past. But like you said, those stimulus programs have been primarily either into the property sector or into the manufacturing sector. And look where we are. They have as much shipbuilding capacity as the rest of the world put together. They have massive amounts of manufacturing capacity that they don't know what to do with. There are 50 million housing units empty across the country. What they need to do, and they seem to be getting to that point now, what they need to do is get their consumers to spend more. And like you said, in a prudent fashion. And it does seem like they're going down that path now.
Ajay, this also dovetails with uncertainty in the political landscape when it comes to the U.S. And I'm curious that really, regardless of who wins the White House, it does feel like heavier tariffs on Chinese goods, particularly on EVs, for example, are going to be a thing. What is that going to do to China growth? How do you model that?
I think it slows China growth down, no question. Like you are implying, the manufacturing sector, the export sector has been the one bright spot in the Chinese economy for the last 3 years. It will slow down. It has to slow down. By itself, it doesn't take more than 20, 30, 40 basis points of growth. What matters far more is that right now the economy seems to be locked in a little bit of a wage/disinflation spiral. They have to change that. They have to get their consumers to spend far more on services, even within China, if that's the way that they want to do it. If that's the case, then the tariffs are something that they will be able to weather okay. If not, I think they are in trouble.
So in a deflationary environment, the tariffs are really bad. If they can get some inflation going, they can weather the storm on tariffs. How much, A, is that right? And B, how much of an inflationary environment would they need to do that?
I mean, right now, you saw the latest numbers come out of inflation. This is a country that has had PPI, input deflation, for 2 straight years. CPI inflation is barely running at 0. Remarkable when, you consider what the rest of the Western world has done. I think they need to get closer to 2%, to be quite honest with you. And they seem very far away from that. And I think you guys are making the exact right point. So the last 30, 35 years, the Chinese have essentially done a quite wealth transfer from their consumers to their manufacturing and investment sectors. They've ended up with too much excess. And now, painful as it is, they need to move that pendulum back in the other direction. They are starting, but they have a lot more to go. That 10 trillion renminbi number that is tossed around, that is a real number. That is the extent of fiscal stimulus they have to do. Consumer focus.
All right, Ajay, we have to leave it there. I really appreciate you taking time for us. Ajay Rajadhyaksha, he's Barclays Global Chairman of Research. A closer discussion here about the world's second largest economy, and I guess potentially, Alex Steele, how the U.S. election could actually affect that relationship.
I think that was the first time I heard about that, though, that if we have deflation, that's where it gets really bad in terms of the tariffs. But if there's inflation, that China can kind of weather it. The tariffs in and of themselves may not be that big of a deal.
Yeah, and you kind of wonder, what has been the impact? I mean, these tariffs have been in place now for quite some time. And, I mean, most of what ails them are independent of those tariffs. At least that's my impression.
Right. But, maybe 60 to 100% tariffs is a different story, but do we even go that far? Yeah. I mean, 30, 40 basis points of growth, it seems like, okay, we can handle that, no?
Yeah, a lot of questions that have to be answered. Maybe they get answered in 3 weeks once we get to the big U.S. election.
Oh, please, you want certainty?
Here.
What are you doing?
Weeks, Alex
what are you doing?
Yes, I want certainty.
Oh.
All right, well, here's what's certain. When we come back after the break, we're going to set you up for what to watch over the next 24 hours. This is The Close on Bloomberg.
Not just big banks tomorrow, but United Airlines set to report results tomorrow, and analysts expecting the carrier to grow as much as 6% in the fourth quarter. George Ferguson of Bloomberg Intelligence, he's senior aerospace, defense, and airlines analyst, joins us now. George, is this going to be a good report? What are you betting on here?
Yeah, so I think this will probably be the best airline report, U.S. airline report for the season. United has heavy exposure to premium leisure. And has good exposure across the Atlantic and to the Pacific. And so I think those are markets that will be performing better. If you compare it to Delta, right? Delta was a little bit of a miss. There was a little bit of disappointment, wasn't terrible. Probably a little bit better than Delta because United has been sort of rounding out its domestic network with bigger airplanes. I think that gives them more premium seating, so the revenue probably performs a little bit better than Delta. Maybe their costs perform a little bit better than Delta as well. So I think United will see, again, maybe one of the best U.S. Airline reports of the season.
Yeah.
May not quite come out exactly where we expect, but it'll be pretty close, I think.
I am curious whether we're going to see these airlines sort of move in sync with some of the decisions that they're making about capacity, about fares, or whether we have certain airlines, i.e. United, that can sort of break away and do its own thing.
Well, so I mean, I think premium still perform better at Delta, and premium's still the right place to be. And there's a lot of folks that are going to try to bring in, I don't know if you want to call it faux premium.
Yeah,
or,
I don't like that.
Fake premium. They're going to block out your middle seat for you, something like that. But those carriers, United, American, Delta, still have the real premium. And again, look, we've seen a lot of demand for transatlantic. When you're going transatlantic for 6 or 7 hours, you want something comfortable. You're more willing to pay up for it. So I think that positions them well to stay ahead of the pack. I hate to think about sort of breaking away in the airline world. I kind of think the products are pretty homogeneous. So, United will do a bit better than Delta, but Delta won't be that far behind it. Nobody, and those two, I think, still stay ahead of the pack, but nobody really breaks too far away in this business, I think.
Real quick about capacity. We saw Delta saying it's going to increase capacity. I thought we needed to take capacity out. What's United going to say / do?
Yeah, and sorry, that was where Romain was going to. Look, I think on the premium side, you don't need as much capacity to come out. I still expect many of the airlines to be growing capacity into 4Q. They're just growing capacity less, right? They'll try to grow into the amount of capacity the marketplace has, right? If you sort of imagine the capacity growth comes down, demand still grows a bit. They sort of grow into the capacity in the marketplace. I think in past quarters, we've just had way too much basic economy capacity coming to the marketplace and too much total capacity. Some of that basic is going to slow down too. You're going to see airlines like JetBlue cutting capacity, Southwest slowing growth. That's going to improve some of the dynamics of the bottom.
Yeah, sorry, George. We got to leave it there. Actually, you're up against time. We didn't even get a chance to ask you about all the mess going on over at Southwest with Elliott, George Ferguson, one of the best in the business, working right here at Bloomberg Intelligence. A breakdown of the results we're expected to get out of United Airlines tomorrow. Analysts right now, on average, expecting about $3.07 on the bottom line. On the top line, looking at passenger revenue, or total operating revenue, I should say, of $14.72 billion. Here's what else we are going to keep an eye on over the next 24 hours that could potentially move the markets, Alex, and that includes some really consequential earnings.
Yep, we got J&J, looking forward to that. Walgreens, Boots Alliance, and of course we got the big banks, Bank of America, Goldman, and Citi. It did seem like Betsy Graseck and Morgan Stanley was hinting that Goldman was going to be great because of the capital markets arm of JP Morgan as well as Wells Fargo. Yeah, I'm interested to see what we get out of Walgreens there. After the market, we do get JB Hunt, and as we were just talking, United Airlines. We also do get some, I guess, secondary, if you want, economic data. Yep, we get Empire Manufacturing. That's coming out at 8:30. I mean, manufacturing continues to be weak, so it's not going to be that much of a surprise. It's been weak forever, and the economy keeps humming along. It's been troughed. It's been troughing. I know there are a lot of broader implications for jobs and politics and stuff, but in terms of its impact on GDP, I'm sorry. Well, it's also not going to tell us anything new. We know manufacturing has been struggling and it's been weak, and so that will probably continue to be the case. All right, and we're also going to get, I know, your favorite, Fed Speak. Do you like Fed Speak or do you not? It depends on who's speaking. Daly, no. Kugler, Bostic, that guy. I don't know why, but for some reason that Bostic guy, I want to hear what he has to say. Well, we did get Fed Williams talking today about how fast to go when it comes to cuts. That's interesting as well. All right, that does us for the close. Balance of Power up next. This is Bloomberg.